General insurance. Before you learn the different types of policies that you will encounter as an insurance producer, you will need to understand some basic terminology and concepts. First, you need to understand what insurance is and who or what may become insured. This chapter will discuss some basic underwriting concepts, address different classifications of insurers, and will end with an explanation of contracts. In general, this chapter will help build a foundation of concepts that will make it easier for you to learn the rest of the material in this course, so it is important for you to master these ideas before moving on to the next chapter. Terms to know. Agent, producer. A legal representative of an insurance company. The classification of producer usually includes agents and brokers. Agents are the agents of the insurer. Applicant or proposed insured. A person applying for insurance. Beneficiary. A person who receives the benefits of an insurance policy. Broker. An insurance producer not appointed by an insurer and is deemed to represent the client. Indemnity. Main principle of insurance, meaning that the insured cannot recover more than their loss. The purpose of insurance is to restore the insured to the same position as before the loss. Insurance policy. A contract between a policy owner and/or insured and an insurance company which agrees to pay the insured or the beneficiary for loss caused by specific events. Insured. The person covered by the insurance policy. This person may or may not be the policy owner, insurer, principal, the company who issues an insurance policy. Law of large numbers. The larger the number of people with a similar exposure to loss, the more predictable actual losses will be. Policy owner. The person entitled to exercise the rights and privileges in the policy. Premium. The money paid to the insurance company for the insurance policy. Reciprocity. Reciprocal. A mutual interchange of rights and privileges. A. Concepts. Insurance is a contract in which one party, the insurance company, agrees to indemnify, make whole, the insured party against loss, damage or liability arising from an unknown event. In life insurance, the policy protects survivors from losses suffered after an insured's death. Insurance is a transfer of risk of loss from an individual or a business entity to an insurance company, which, in turn, spreads the costs of unexpected losses to many individuals. If there were no insurance mechanism, the cost of a loss would have to be borne solely by the individual who suffered the loss. Know this: insurance is the transfer of risk of loss. The cost of an insured's loss is transferred over to the insurer and spread among other insureds. 1. Risk management. Key terms. Risk. Risk is the uncertainty or chance of a loss occurring. The two types of risks are pure and speculative, only one of which is insurable. Pure risk refers to situations that can only result in a loss or no change. There is no opportunity for financial gain. Pure risk is the only type of risk that insurance companies are willing to accept. Speculative risk involves the opportunity for either loss or gain. An example of speculative risk is gambling. These types of risks are not insurable. Know this: only pure risks are insurable. Hazards are conditions or situations that increase the probability of an insured loss occurring. Hazards are classified as physical hazards, moral hazards, or morale hazards. Conditions such as lifestyle and existing health, or activities such as scuba diving, are hazards and may increase the chance of a loss occurring. Physical hazards are individual characteristics that increase the chances of the cause of loss. Physical hazards exist because of a physical condition, past medical history, or a condition at birth, such as blindness. Moral hazards are tendencies towards increased risk. Moral hazards involve evaluating the character and reputation of the proposed insured. Moral hazards refer to those applicants who may lie on an application for insurance, or in the past, have submitted fraudulent claims against an insurer. Morale hazards are similar to moral hazards, except that they arise from a state of mind that causes indifference to loss, such as carelessness. Actions taken without a forethought may cause physical injuries. Perils are the causes of loss insured against in an insurance policy. Life insurance insures against the financial loss caused by the premature death of the insured. Health insurance insures against the medical expenses and/or loss of income caused by the insured's sickness or accidental injury. Property insurance insures against the loss of physical property or the loss of its income-producing abilities. Casualty insurance insures against the loss and/or damage of property and resulting liabilities. Loss is defined as the reduction, decrease, or disappearance of value of the person or property insured in a policy, caused by a named peril. Insurance provides a means to transfer loss. Know this: a risk is a chance that a loss will occur. A hazard increases the probability of loss. A peril is the cause of loss. Exposure is a unit of measure used to determine rates charged for insurance coverage. In life insurance, all of the following factors are considered in determining rates: the age of the insured, medical history, occupation, and sex. A large number of units having the same or similar exposure to loss is known as homogeneous. The basis of insurance is sharing risk among the members of a large homogeneous group with similar exposure to loss. 2. Methods of handling risk avoidance. One of the methods of dealing with risk is avoidance, which means eliminating exposure to a loss. For example, if a person wanted to avoid the risk of being killed in an airplane crash, she might choose never to fly in an airplane. Risk avoidance is effective, but seldom practical. Risk retention is the planned assumption of risk by an insured through the use of deductibles, county payments, or self-insurance. It is also known as self-insurance when the insured accepts the responsibility for the loss before the insurance company pays. The purpose of retention is 1. To reduce expenses and improve cash flow. 2. To increase control of claim reserving and claims settlements, and 3. To fund for losses that cannot be insured. Sharing is a method of dealing with risk for a group of individual persons or businesses with the same or similar exposure to loss to share the losses that occur within that group. A reciprocal insurance exchange is a formal risk-sharing arrangement. Reduction. Since we usually cannot avoid risk entirely, we often attempt to lessen the possibility or severity of a loss. Reduction would include actions such as installing smoke detectors in our homes, having an annual physical to detect health problems early, or perhaps making a change in our lifestyles. Transfer. The most effective way to handle risk is to transfer it so that the loss is borne by another party. Insurance is the most common method of transferring risk from an individual or group to an insurance company. Though the purchasing of insurance will not eliminate the risk of death or illness, it relieves the insured of the financial losses these risks bring. There are several ways to transfer risk, such as hold harmless agreements and other contractual agreements, but the safest and most common method is to purchase insurance coverage. 3. Elements of insurable risks. Not all risks are insurable. As noted earlier, insurers will insure only pure risks, or those that involve only the chance of loss with no chance of gain. Furthermore, even pure risks must have certain characteristics in order to be insurable. Insurable risks involve the following characteristics. Due to chance, a loss that is outside the insured's control. Definite and measurable. A loss that is specific as to the cause, time, place and amount. An insurer must be able to determine how much the benefit will be and when it becomes payable. Statistically predictable. Insurers must be able to estimate the average frequency and severity of future losses and set appropriate premium rates. In life and health insurance, the use of mortality tables and morbidity tables allows the insurer to project losses based on statistics. Not catastrophic. Insurers need to be reasonably certain their losses will not exceed specific limits. That is why insurance policies usually exclude coverage for loss caused by war or nuclear events. There is no statistical data that allows for the development of rates that would be necessary to cover losses from events of this nature. Randomly selected and large loss exposure. There must be a sufficiently large pool of the insured that represents a random selection of risks in terms of age, gender, occupation, health and economic status, and geographic location. 4. Law of large numbers. The basis of insurance is sharing risk among a large pool of people with a similar exposure to loss, a homogeneous group. The law of large numbers states that the larger the number of people with a similar exposure to loss, the more predictable actual losses will be. This law forms the basis for statistical prediction of loss upon which insurance rates are calculated. Example: when an insurance company issues a policy on a 35-year-old male, the company really has no way of knowing or accurately predicting when he will die. However, the law of large numbers looks at a large group of similar risks, 35-year-old males of similar lifestyles and health conditions, and makes some conclusions based on statistics of past losses. This allows the insurance company to have a general idea about the predicted time of death for this type of insured and to set the premiums accordingly. Know this: as the number of people in a risk pool increases, future losses become more predictable. 5. Adverse selection. Insurance companies strive to protect themselves from adverse selection, the insuring of risks that are more prone to losses than the average risk. Poorer risks tend to seek insurance or file claims to a greater extent than better risks. To protect themselves from adverse selection, insurance companies have an option to refuse or restrict coverage for bad risks, or charge them a higher rate for insurance coverage. B. Insurers. The insurer, or principal, is the company or organization that issues a policy of insurance. Insurance is available from both private companies and the government. The major difference between government and private insurance is that the government programs are funded with taxes and serve national and state social purposes, while private policies are funded by premiums. Private insurance companies can be classified in a variety of ways: ownership, authority to transact business, location, domicile, marketing and distribution systems, or rating, financial strength. As you read about different classifications of insurers, keep in mind that these categories are not mutually exclusive, and the same company can be described based on where it is located and allowed to transact the business of insurance, who owns it, and what type of agents it appoints. 1. Stock and mutual insurers. Based on their structure and ownership, insurers are classified as either stock or mutual. Stock companies are owned by the stockholders who provide the capital necessary to establish and operate the insurance company. Profits and losses from operations are shared among stockholders. Mutual companies are owned by the policy owners and issue participating policies. Under a mutual ownership, earnings are returned to policy owners as non-taxable dividends. Dividends, however, are never guaranteed. 2. Fraternal Benefit Society. A fraternal benefit society is an insurance company formed to provide insurance for people and organizations who share a common affiliation. Examples of common fraternal benefit society members include religious institutions, lodges, and non-profit mutual aid organizations. Fraternals sell only to their members and are considered charitable institutions, and not insurers. 3. Domestic, foreign, and alien domicile of insurer. Insurers can also be defined by their location of incorporation and whether or not they are authorized to write business in a state. The insurer's domicile, or location of incorporation, will determine whether an insurance company is considered domestic, foreign or alien. In the state they are incorporated in, they are considered a domestic insurer. If the insurer is operating in a state other than the one they are incorporated in, they are called a foreign insurer. If the insurer is incorporated outside the United States, they are considered an alien insurer. 4. Admitted versus non-admitted. An admitted or authorized insurer is an insurance company that has qualified and has received a certificate of authority from the Department of Insurance to transact insurance in the state. A non-admitted or non-authorized insurer is an insurance company that has not applied, or has applied and been denied, a certificate of authority and may not transact insurance. See Producers and Law of Agency. An agent-producer is an individual licensed to sell, solicit or negotiate insurance contracts on behalf of the principal, insurer. The law of agency defines the relationship between the principal and the agent-producer. The acts of the agent-producer within the scope of authority are deemed to be the acts of the insurer. In this relationship, it is a given that an agent represents the insurer, not the insured. Any knowledge of the agent is presumed to be knowledge of the insurer. If the agent is working within the conditions of his/her contract, the insurer is fully responsible. And when the insured submits payment to the agent, it is the same as submitting a payment to the insurer. The agent is responsible for accurately completing applications for insurance, submitting the application to the insurer for underwriting, and delivering the policy to the policy owner. Know this: insurance agents represent the insurer, principal. Who is your pal? The principal. 1. Authority and powers of producers. The agency contract details the authority an agent has within his/her company. Contractually, only those actions that the agent is authorized to perform can bind the principal, insurer. In reality, an agent's authority is much broader. There are 3 types of agent authority: express, implied, and apparent. Express authority is the authority a principal intends to grant to an agent by means of the agent's contract. It is the authority that is written in the contract. Implied authority is authority that is not expressed or written into the contract, but which the agent is assumed to have in order to transact the business of insurance for the principal. Implied authority is incidental to and derives from express authority, since not every single detail of an agent's authority can be spelled out in the written contract. Example: if the agency contract does not specifically authorize the agent to collect premiums and remit them to the insurer, but the agent routinely does so in the process of solicitation and delivery of policies, the agent has the implied authority to collect and remit premiums. Apparent authority, also known as perceived authority, is the appearance or the assumption of authority based on the actions, words, or deeds of the principal or because of circumstances the principal created. For example, if an agent uses insurer's stationery when soliciting coverage, an applicant may believe that the agent is authorized to transact insurance on behalf of the insurer. D. Contracts. A contract is an agreement between two or more parties enforceable by law. Because of unique aspects of insurance transactions, the general law of contracts had to be modified to fit the needs of insurance. 1. Elements of a legal contract. In order for insurance contracts to be legally binding, they must have 4 essential elements. 1. Agreement, offer and acceptance. 2. Consideration. 3. Competent parties. And 4. Legal purpose. Offer and acceptance. There must be a definite offer by one party, and the other party must accept this offer in its exact terms. In insurance, the applicant usually makes the offer when submitting the application. Acceptance takes place when an insurer's underwriter approves the application and issues a policy. Consideration. The binding force in any contract is the consideration. Consideration is something of value that each party gives to the other. The consideration on the part of the insured is the payment of premium and the representations made in the application. The consideration on the part of the insurer is the promise to pay in the event of loss. Know this: insurer's consideration is the promise to pay for losses. Insured's consideration is the payment of premium and statements on the application. Competent parties. The parties to a contract must be capable of entering into a contract in the eyes of the law. Generally, this requires that both parties be of legal age, mentally competent to understand the contract, and not under the influence of drugs or alcohol. Legal purpose. The purpose of the contract must be legal and not against public policy. To ensure legal purpose of a life insurance policy, for example, it must have both insurable interest and consent. A contract without a legal purpose is considered void, and cannot be enforced by any party. 2. Legal interpretations affecting contracts. Reasonable expectations. It is not always practical or necessary to state every direct and indirect provision or coverage offered by an insurance policy. If an agent implies through advertising, sales literature or statements that these provisions exist, an insured could reasonably expect coverage. Indemnity. Indemnity, sometimes referred to as reimbursement, is a provision in an insurance policy that states that in the event of loss, an insured or a beneficiary is permitted to collect only to the extent of the financial loss, and is not allowed to gain financially because of the existence of an insurance contract. The purpose of insurance is to restore, but not let an insured or a beneficiary profit from the loss. Life and health example. Brenda has a health insurance policy for $20,000. After she was hospitalized, her medical expenses added up to $15,000. The insurance policy will reimburse Brenda only for $15,000, the amount of the loss, and not for $20,000, the total amount of insurance. Property and casualty example. Brenda has a homeowner's insurance policy for $200,000. After her home was destroyed, her expense to rebuild the home added up to $150,000. The insurance policy will reimburse Brenda only for $150,000, the amount of the loss, and not for $200,000, the total amount of insurance. Know this: indemnity means insureds cannot recover more than their loss. Utmost good faith. The principle of utmost good faith implies that there will be no fraud, misrepresentation or concealment between the parties. As it pertains to insurance policies, both the insurer and insured must be able to rely on the other for relevant information. The insured is expected to provide accurate information on the application for insurance, and the insurer must clearly and truthfully describe policy features and benefits, and must not conceal or mislead the insured. Representations and misrepresentations. Representations are statements believed to be true to the best of one's knowledge, but they are not guaranteed to be true. For insurance purposes, representations are the answers the insured gives to the questions on the insurance application. Untrue statements on the application are considered misrepresentations and could void the contract. A material misrepresentation is a statement that, if discovered, would alter the underwriting decision of the insurance company. Furthermore, if material misrepresentations are intentional, they are considered fraud. Know this: representations are statements believed to be true. Insured statements on the application are representations. A warranty is an absolutely true statement upon which the validity of the insurance policy depends. Breach of warranties can be considered grounds for voiding the policy or a return of premium. Because of such a strict definition, statements made by applicants for life and health insurance policies, for example, are usually not considered warranties, except in cases of fraud. Concealment is the legal term for the intentional withholding of information of a material fact that is crucial in making a decision. In insurance, concealment is the withholding of information by the applicant that will result in an imprecise underwriting decision. Concealment may void a policy. Fraud is the intentional misrepresentation or intentional concealment of a material fact used to induce another party to make or refrain from making a contract, or to deceive or cheat a party. Fraud is grounds for voiding an insurance contract. Federal laws and regulations. 1. Fair Credit Reporting Act. The Fair Credit Reporting Act established procedures that consumer reporting agencies must follow in order to ensure that records are confidential, accurate, relevant, and properly used. The law also protects consumers against the circulation of inaccurate or obsolete personal or financial information. The acceptability of a risk is determined by checking the individual risk against many factors directly related to the risk's potential for loss. Besides these factors, an underwriter will sometimes request additional information about a particular risk from an outside source. These reports generally fall into two categories: consumer reports and investigative consumer reports. Both reports can only be used by someone with a legitimate business purpose, including insurance underwriting, employment screening, and credit transactions. Consumer reports include written and/or oral information regarding a consumer's credit, character, reputation, or habits collected by a reporting agency from employment records, credit reports, and other public sources. Investigative consumer reports are similar to consumer reports in that they also provide information on the consumer's character, reputation, and habits. The primary difference is that the information is obtained through an investigation and interviews with associates, friends and neighbors of the consumer. Unlike consumer reports, these reports cannot be made unless the consumer is advised in writing about the report within 3 days of the date the report was requested. The consumers must be advised that they have a right to request additional information concerning the report, and the insurer or reporting agency has 5 days to provide the consumer with the additional information. Know this: insurance applicants must be notified in writing whenever insurers request investigative consumer reports. The reporting agency and users of the information are subject to civil action for failure to comply with the provisions of the Fair Credit Reporting Act. A person who knowingly and willfully obtains information on a consumer from a consumer reporting agency under false pretenses may also be fined and/or imprisoned for up to 2 years. An individual who unknowingly violates the Fair Credit Reporting Act is liable in the amount equal to the loss to the consumer, as well as any reasonable attorney fees incurred in the process. An individual who willfully violates this act enough to constitute a general pattern or business practice will be subject to a penalty of up to $2,500. Under the Fair Credit Reporting Act, if a policy of insurance is declined or modified because of information contained in either a consumer or investigative report, the consumer must be advised and provided with the name and address of the reporting agency. The consumer has the right to know what was in the report. The consumer also has a right to know the identity of anyone who has received a copy of the report during the past year. If the consumer challenges any of the information in the report, the reporting agency is required to reinvestigate and amend the report, if warranted. If a report is found to be inaccurate and is corrected, the agency must send the corrected information to all parties to which they had reported the inaccurate information within the last 2 years. Consumer reports cannot contain certain types of information if the report is requested in connection with a life insurance policy or credit transaction of less than $150,000. The prohibited information includes bankruptcies more than 10 years old, civil suits, records of arrest or convictions of crimes, or any other negative information that is more than 7 years old. As defined by the Act, negative information includes information regarding a customer's delinquencies, late payments, insolvency or any other form of default. 2. Prohibited persons in insurance waiver. Federal Law 18 U.S.C. Sections 1033 and 1034. It is considered unlawful insurance fraud for any person engaged in the business of insurance to willfully, and with the intent to deceive, make any oral or written statement that are either false or omit material facts. This includes information and statements made on an application for insurance, renewal of a policy, claims for payment or benefits, premiums paid, and financial condition of an insurer. Anyone engaged in the business of insurance whose activities affect interstate commerce, and who knowingly makes false material statements may be fined, imprisoned for up to 10 years or both. If the activity jeopardizes the security of the accompanied insurer, the punishment can be up to 15 years. Anyone acting as an officer, director, agent or other insurance employee who is convicted of embezzling funds faces the aforementioned fines and imprisonment. However, if the embezzlement was in an amount less than $5,000, prison time may be reduced to 1 year. Federal law makes it illegal for any individual convicted of a crime involving dishonesty, breach of trust or a violation of the Violent Crime Control and Law Enforcement Act of 1994 to work in the business of insurance affecting interstate commerce without receiving a letter of written consent from an insurance regulatory official, a 1033 waiver. The consent of the official must specify that it is granted for the purpose of 18 U.S.C. 1033. Anyone convicted of a felony involving dishonesty or breach of trust, who also engages in the business of insurance, will be fined, imprisoned for up to 5 years or both. Section 1034. Civil penalties and injunctions for violations of Section 1033. States that the Attorney General may bring a civil action in the appropriate U.S. District Court against any person who engages in conduct that is in violation of Section 1033 of not more than $50,000 for each violation, or the amount of compensation the person received as a result of the prohibited conduct, whichever is greater. 3. National Do Not Call List. In 2003, the Federal Trade Commission, FTC, and the Federal Communications Commission, FCC, worked together to create the National Do Not Call Registry, allowing consumers to include their telephone numbers on the list to which solicitation calls cannot be made by telemarketers. Insurance companies need to comply with this regulation when making solicitation phone calls. To comply with the telemarketing sales rules, telemarketers must not do any of the following: call any number on the National Do Not Call Registry or on that seller's Do Not Call list. Deny someone a right to be placed on any Do Not Call registry. Call outside permissible calling hours, before 8 a.m. and after 9 p.m. Abandon calls. Fail to transmit caller ID information. Threaten or intimidate a consumer or use obscene language. Or cause any telephone to ring or engage a person in conversation with the intent to annoy, abuse, or harass the person called. Some exceptions to the Do Not Call registry include the following calls: from or on behalf of organizations which have established a business relationship with the consumer, for the last 18 months from the date of a sale or transaction, for which the consumer has given prior written permission, not commercial or that do not include unsolicited advertisements, and by or on behalf of tax-exempt nonprofit organizations. To keep in compliance with the Do Not Call rules, organizations must consult the registry every 31 days. Any phone numbers on the registry must be dropped from the organization's call lists. 4. Privacy protection. Gramm-Leach-Bliley Act. The Gramm-Leach-Bliley Act stipulates that in general, an insurance company may not disclose non-public personal information to a non-affiliated third party except for the following reasons. The insurance company clearly and conspicuously discloses to the consumer in writing that information may be disclosed to a third party. The consumer is given the opportunity, before the time that information is initially disclosed, to direct that information not be disclosed to the third party. Or the consumer is given an explanation of how the consumer can exercise a non-disclosure option. The Gramm-Leach-Bliley Act requires 2 disclosures to a customer: a consumer who has an ongoing financial relationship with a financial institution. 1. When the customer relationship is established, i.e., a policy is purchased, and 2. Before disclosing protected information. The customer must also receive an annual privacy disclosure, and have the right to opt out, or choose not to have their private information shared with other parties. 5. CAN-SPAM Act. CAN-SPAM legislation was established to set the rules for commercial email, and to give recipients the right to reject commercial messages. CAN-SPAM covers all commercial electronic messages, including business-to-business messages, the purpose of which is the commercial advertisement or promotion of a product or service. CAN-SPAM requires that any commercial email must contain an opt-out mechanism. All opt-out requests must be honored within 10 business days. To be in compliance with this legislation, the entity that sends out emails must do the following. Make sure that the advertiser is identified in the from line. Not use misleading subject lines. Include an opt-out mechanism and honor all opt-out requests within 10 days. Include the advertiser's valid physical postal address. And if the message is unsolicited, it must be identified as an advertisement somewhere in the email. Each violation of the above provisions is subject to fines of up to $16,000. On top of that is a penalty of $250 per each non-compliant email, with a cap of $2 million. F Chapter Recap. This chapter was all about giving you the basics of insurance. Let's recap some of the major points. General concepts. Insurance transfers the risk of loss from an individual to an insurer based on the principle of indemnity, based on the spreading of risk, risk pooling, and the law of large numbers. Hazards. Hazards give rise to a peril. There are 3 kinds of hazards. Physical condition. Moral, a tendency toward increased risk. Morale and indifference to loss. Risk, uncertainty regarding financial loss. 2 types of risks. Pure insurable because it involves a chance of loss only. Speculative not insurable because it involves a chance of gain. Methods of handling risk: avoidance, retention, sharing, reduction. Transfer elements of insurance risk. All of the following elements apply to an insurable risk. Due to chance. Chance of loss beyond insured's control definite and measurable. Loss must have definite time, place and amount. Predictable. Number of losses must be statistically predictable. Not catastrophic. There must be limits that the loss can't exceed large exposure. Insurer must be able to predict losses based on the law of large numbers. Randomly selected exposure. Insurer must have a fair proportion of both good and poor risks. Agent's authority. Express authority specifically stated in the contract, implied not specifically stated in the contract, but is assumed necessary to conduct insurance business. Apparent. The appearance of a relationship between the agent and principal based on words or actions. Company domicile and authorization. Domicile: domestic, incorporated in this state. Foreign, incorporated in another state or U.S. territory. Alien, incorporated in another country. Authorized, admitted, approved by the Department of Insurance, has a certificate of authority. Unauthorized, non-admitted, no certificate of authority, cannot transact business in this state. Insurance contracts. Elements of a legal contract. All of the following requirements apply. Agreement. Offer and acceptance. Consideration. Premiums and representations on the part of the insured. Payment of claims on the part of the insurer. Competent parties. Of legal age, sound mental capacity, and not under the influence of drugs or alcohol. Legal purpose. Not against public policy. Legal interpretations. Ambiguities in the contract are always resolved in favor of the insured. The insured can reasonably expect coverage based on the agent's words and actions. Utmost good faith. Parties rely on each other for information. Material misrepresentations, if intentional, breach of warranties, concealment, fraud, all can void the contract. Waiver. Voluntary act of relinquishing a legal right. Estoppel. Consequence of a waiver. Thanks for watching.